Hello candidates, welcome to our today's financial accounting lesson. The topic is financial statements of a manufacturing entity. In our last lesson, we learned how to treat the manufacturing profit, how to record the manufacturing profit. Remember, we say that there are some companies that have a policy of releasing the finished goods from the factory to the warehouse at the market value, which is the cost of production plus the profit, what we called the manufacturing profit. In our today's lesson, we want to learn how to treat the unrealized profit in the books of a manufacturing entity. So the topic is financial statements of a manufacturing entity. Financial statements of a manufacturing entity. And the subtopic is treatment of unrealized profit. Unrealized profit. How do you record unrealized profit in the books of a manufacturing entity? Before we consider the treatment, you need to understand what's the meaning of unrealized profit. Unrealized profit is a profit that has not been realized. Profit that has not been realized. When a manufacturing firm releases its finished goods from the factory to the warehouse as finished goods at the market price, at the market value, meaning production, that is market value. The market value of goods is equal to the cost of production plus the manufacturing profit. So goods in this case would be valued at the market value, which means incorporated in this value is a profit element, so that at the end of the accounting period, if you have stock of finished goods, if there are stocks of finished goods, then that would mean that the profit, because the purpose for producing goods is to sell. Profit is only realized after sale. After there is sale of finished goods, that is when profit is realized. But at the end of the accounting period, if the company still has stock of finished goods in the warehouse, then it means that there is what we are referring to as unrealized profit. There is profit that has not been realized because the unrealized profit is the unrealized profit is the unrealized profit, that difference between the cost of goods produced and the market value or the selling price of the goods, that would constitute the unrealized profit. I want you to write another sentence. The difference between the unrealized profit, the difference between the unrealized profit on the difference between the unrealized profit on the opening stock of finished goods, opening stock of finished goods and the unrealized profit, okay, and the unrealized profit on the stock of finished on the opening stock. This is the unrealized profit on the closing stock, the difference between the two, the unrealized profit on the opening stock, the difference between the unrealized profit on the opening stock and the unrealized profit on the closing stock should be charged to the profit and loss account. That is one treatment. Remember, we've talked about, we are learning how to treat unrealized profit. Now we are learning how to do the financial statements of a manufacturing entity. So, treatment of unrealized profit in the profit and loss account. This is a financial statement, okay? How do you record unrealized profit in the financial statement, which is the profit and loss account? So, one treatment is that the difference between the unrealized profit on the opening stock and the unrealized profit on the closing stock, the difference should be charged to the profit and loss account. That is one treatment. Then another point, the provision on the unrealized profit, on the closing stock at the end of the accounting period should be subtracted from the market value of finished goods at the end of the period in the balance sheet. I repeat, the provision of the unrealized profit on the closing stock at the end of the period should be deducted from the market value of finished goods in the balance sheet at the end of the accounting period. That's another treatment of unrealized profit in the financial statement, which is the balance sheet. So the unrealized profit affects both the income statement and the balance sheet. In the balance sheet, I've just said, the provision for unrealized profit the provision for unrealized profit, the provision for unrealized profit on the closing stock of finished goods, at the end of the accounting period. End of the accounting period should be deducted or deducted from the market value of finished goods, goods in the balance sheet. Balance sheet statement of financial position. That is how the unrealized profit affects the financial statements, which is the balance sheet. We also stated how the unrealized profit affects the profit and loss account, which is also a financial statement. Before we do an illustration, let me demonstrate using fictitious figures or symbols. So the first financial statement is a profit and loss account. We've said that the difference between the unrealized profit on the opening stock of finished goods and the provision of unrealized profit on the closing stock. Okay, so here we have unrealized profit account. This account ideally should have a credit balance. So the balance at the start, balance brought down, you can have balance brought down there, then balance carried down at the end. The balance carried down at the end, ideally this account, the balance carried down on unrealized profit should be on the debit side. So the difference between these two, balances, and the difference can either be on this side or on this side, depending on the values. The balancing figure can either appear on the debit side or on the credit side. If the balance appears on the credit side, then it means this is an increase. Okay, this is an increase in the provision for unrealized profit. This is provision for unrealized profit account. So if you have a figure of say 10 million, and at the end here you have a balance of say 15 million shillings. So assuming we have these two, then the balancing figure will appear on the credit side and it will be 5 million. So this is an increase in provision for unrealized profit. So this increase in the provision for unrealized profit, the double entry, since we have credited this account, then the double entry will appear here. We'll have 5 million appearing there. This is unrealized profit if there is an increase. But at times you may have a decrease from, say, the 10 million, you may have a decrease here of, say, 7 million. So you see the balancing figure will appear on this side of 3 million. So the double entry will be to debit the provision for unrealized profit and credit the profit and loss account, unrealized profit 3 million. So where there is an increase in provision for unrealized profit, then since we are recording on the debit side, we record it under the other expenses. So this becomes an expense, like an expense. But where there is a reduction in the provision of, say, the 3 million, you see we are recording it on the credit side. And if you are recording it on the credit side, you see we are recording it on the side of the gross profit. So it's like an income. It's like an income. So candidates, you don't need to memorize the double entry. Just understand the double entry. If you are debiting this side, then since you are debiting, double entry rule dictates that for every debit entry there must be a corresponding credit entry. So the corresponding credit here is to credit the profit and loss account, and where there is an increase, the corresponding debit entry will be to debit the profit and loss account. So having understood the treatment of unrealized profit in both the profit and loss account and the balance sheet, we can now have an example. Can we now illustrate? I read this question. It's a past paper question. The following balances have been extracted from the books of Limuru Manufacturers, a small-scale manufacturing enterprise, as at 31st December 2002. So we have the balances there. Balances. Stocks are shown, raw materials, work in progress, finished goods. Purchase of raw materials is also shown. Direct labor, factory overheads, both variable and fixed, administrative expenses, rent and rates, lighting, stationery and postage, staff salaries. Then there is sales down there of 192 million, plant and machinery at cost 30 million, provision for depreciation 12 million, motor vehicles for sales deliveries at cost, that one is for sales delivery. That means that the motor vehicle is not meant for the factory but for sales. Then we have creditors, debtors, drawings, balance at bank, capital on 1st January 2002, provision for unrealized profit as at January, we have it there. Motor vehicle running costs. Additional information number 1, stocks as at 31st December 2002, raw materials, work in progress, finished goods. Number 2, the factory output is transferred to the trading account at factory cost plus 25% of factory profit. Then number 3, depreciation is provided at the rates shown below on original cost of fixed assets held at the end of each financial year. Plant and machinery 10%, motor vehicles 25%. Number 4, amounts accrued at 31st December 2002 for direct labor amounted to 3 million, and rent and rates prepaid at 31st December 2002 amounted to 2 million. Required manufacturing, trading and profit and loss account for the year ended 31st December. Then number 2, the balance. Part 2B, part 2, balance sheet as at 31st December 2002. So that is the question. So we are required to prepare the manufacturing, trading and loss account for Limuru Manufacturers. So I'll have illustration. We want to illustrate unrealized profit. but we want to use a complete question. This is a past paper question. The name of the company, Limuru Manufacturers. We want to prepare the manufacturing trading and profit and loss account. Trading and loss account for the year ended 31st December 2002. So I'll have two columns. We can have them in thousands. Yes, in thousands. So we will first do the manufacturing account. Now the manufacturing account helps us to determine the cost of production, cost of manufacturing, and in this question we told that the company releases goods from the factory at a markup of 25% on the cost of production. So we'll first do the cost of production, then we'll add the profit to get the finished goods, the market value of finished goods. So let's start with the cost of raw materials. Cost of raw materials will have this is the cost of raw materials. Cost of raw materials, we have the opening stock, of 7 million. We'll add purchases of raw materials of 38 million. Then we will get these two 0, 0, 0. We have 5, 4. Then we less closing stock. The closing stock of raw materials. Closing stock of raw materials 9 million. 9 million. Deduct. This will be equal to 636 is the cost of raw materials consumed. Cost of raw materials consumed. After determining the cost of raw materials consumed, we can now calculate the cost of labor. Cost of labor. Now the cost of labor is 28 million, but not number 4. Not number 4. We have accrued direct labor of 3 million. So accrued or labor in arrears we add, right? We add. So we have direct labor. We'll add 28 million plus 3 million to get 31 million. 31 million. Then we do not have the direct expenses. So we get these two. This will be equal to 67,000. This 67,000 is what we call the prime cost. Prime cost is equal to cost of raw materials plus cost of direct labor plus cost of direct expenses. Direct labor, direct expenses plus direct materials. Direct material, direct labor, direct expenses will give you the prime cost. In this question we do not have direct expenses, but we have factory overheads. We'll add the factory overheads. Factory overheads are simply the indirect expenses, and they are grouped into two here: variable and fixed. Variable and fixed. Variable factory overheads 16 million. We add the fixed factory overheads of 9 million. Then we have depreciation on plant and machinery. Depreciation on plant and machinery. Note number 3, depreciation is provided at the rate shown below on the original cost of fixed assets held at the end of the year. The cost of plant and machinery is equal to, moving down there, below sales we have plant and machinery 30%. All right, 30%. So we'll apply 10%, that is 30 million. Below sales we have plant and machinery at cost 30 million. And note number 3, plant and machinery depreciation on cost 10% per annum. 10% per annum. So depreciation, plant and machinery is 30 million times 10%. 30 million times 10% is equal to 3 million. To 3 million. So this total will give us the factory overheads. 16 million plus 12 million, this is equal to 28 million. 28 million. So we add the overheads to the prime cost. Overheads to the prime cost. That will give us production costs minus work in progress. Work in progress. So let me use my machine. So I'm going to add this 67 plus 28. It's 95 million. This total 95 million. Then we'll add the opening work in progress, then less closing work in progress. The opening work in progress 5 million, 8 million. 5 million we add, deduct 8 million. So that will give us the production cost 95 plus 5 minus 8 is 92 million is the cost of production. The cost of production, or the production cost. Cost of production. It is on this cost of production that we'll apply the 25% to get the manufacturing profit. Manufacturing profit 25% times 92 million. 25% times 92 million This is 92 million times 25%. So the manufacturing profit is equal to 23 million. 23 million plus 92 million is equal to 115. Now this 115 is what we were referring to as the market value. Market value of finished goods. Market value of finished goods. This is the value that will represent purchases. Manufacturing entities do not buy finished goods. They convert the raw materials into finished goods. So the value, total value of finished goods is what will represent purchases in the trading account. There are those companies which do not add the manufacturing profit to the production cost. This company's policy is to add 25% of the cost of production to get the market value. Other companies simply work with the 92, which is the cost of production. And if you remember in our last lesson, if I was to take you back, in the last lesson we talked about manufacturing profit, and we said that the manufacturing profit, the double entry for manufacturing profit is to debit. We say that we debit the manufacturing account and credit the profit and loss account. Here we are preparing these records using the vertical method. But if you are to do the horizontal method, then this is what we will have. Manufacturing account. Candidates will appreciate that all these are costs. They are costs. And if they are costs, then the manufacturing account will be debited by all these costs. We have the prime cost of 36 million. There is the direct labor of 31 million. We have the factory overheads of 28 million. This is factory overheads, which we had a total of 95. This 95 million. Then we deducted the opening work in progress, and then deducted the closing work in progress of 8 million, 5 million. So we had a total cost of production here of 92 million. Then of course the manufacturing profit. So you can see here manufacturing profit is debited on this account. The manufacturing profit is debited on this account, and the double entry will be to credit the profit and loss account. So below the other incomes, all right, below the other incomes, like the gross profit, after the gross profit here, we'll have double entry, manufacturing profit. We'll add it to this profit. That is the double entry. When we said in our last lesson that the manufacturing profit, double entry, debit, the manufacturing account, credit, profit and loss account, this is what I meant. The manufacturing profit here is debited, and the corresponding double entry is to credit the profit and loss account. Profit and loss account. Then learners, just for the sake of expanding knowledge, to expand your knowledge, this manufacturing account, you can see the balancing figure on this account, because here we'll have 15. Expanding your knowledge here a bit, this is the manufacturing profit. We added it to the cost there to get this is total of this was 23 million, total of 115 million. This 115 million, this is the total market value. This is the total market value, the total market value. To close this account, we get the balancing figure of, there is a balancing figure here of 115 million. Now this 115 million is closed to the trading account. Trading account, this is what now will be transferred. If you are doing the horizontal, this is what you do. If you are doing the horizontal format, we will close this 115. We not write balance carry down, but we close it to the trading account, and that is what we want to do next. We have done the manufacturing account, so this is the manufacturing account, manufacturing account. We want now to proceed to the trading account, and as usual, the trading account, we start with the sales. From the question, the sales figure is 192 million. 192 million. So we compute the cost of sales. The cost of sales. Now, candidates, when you are selling, you sell the finished products. So we'll start with the opening stock of finished products. Opening stock of finished goods. What is the opening stock? The opening stock is 6.9 million. 6.9 million. We'll add the market value of goods transferred, the double entry here, learners. This is a market value of goods from manufacturing. Okay, this is market value of goods from the factory. Market value of goods from the factory, 115 million. Then do you have the closing stock? Yes, closing stock. You have the closing stock. The closing stock of 10 million 350. 10 million 350. We deduct. That will give us the cost of sales. 6.9 plus 115 minus 10 350, 10,350. So I have here 111555 minus 192 million 80 450. 80 450 is the gross profit. That is the gross profit. Then we add other incomes like the manufacturing profit. This manufacturing profit, this one here of 23 million. Add 23 million. So 23 million. This is 80 450 plus 23 million. The total income here is 103 450. 103 450 is the total income. Then we deduct expenses. Expenses from the total income. Expenses from the total income. So this is total income. We'll have here expenses. Expenses, note number, the first one there is rent and rates. After the factory overheads, rent and rates is the first expense. That will need an adjustment. If you are to check note number 4, we are told that and the rent and rates prepaid at 31st amounted to 2 million. Rent and rates prepaid. So rent and rates prepaid, the amount there is 19 million. This is 19 million. We will deduct prepaid amount of 2 million, deduct to get 17 million, which is the rent for the year. Then next is the lighting. Does not need any adjustment, so we just record the way it is there. Lighting is 6 million. Next, after lighting, stationery and postage. Stationery and postage, 2 million. Stationery and postage. Staff salaries 19,380. 19,380 staff salaries. What else? Depreciation, note number 3, depreciation is provided at the rates of original cost, fixed assets, motor vehicles, 25%. Depreciation, motor vehicles, 25% of the original cost, which is 16 million times 16 million. That will give us the depreciation. 16 million times 25%, 4 million. 4 million depreciation. Then what else? We've done everything apart from provision for unrealized profit. Provision for unrealized profit. This was the subject over today's lesson. So we have to open a working provision for unrealized profit account. Provision for the unrealized profit account. If you are to check, learners, if you are to check the balances, the second last item, you can see there, provision for unrealized profit as at January 2002, 1,380,000. That is a credit balance. There is a balance there brought down. Balance brought down 1380. 1380. So we need to calculate the unrealized profit at the end here. Balance carried down at the end. Then we see if the balancing figure will be an increase or a decrease in provision for unrealized profit. And how do we determine the provision for unrealized profit at the end? That is simple. We will check the finished goods at the end, and in note number 1, the finished goods is valued at 10,000. 10,350,000 is the finished goods. The market value of finished goods 10,350,000. So learners, the 10,350,000 is the market value of finished goods at the end. We need to determine the profit element in the 10,350. This 10,350 is inclusive of the manufacturing profit. Okay, that means this is a representation of the 125%. That is 100% plus 25 will give us the 125%, which represents the market value of the finished goods. Therefore, what will be 25%? Because we are looking for this 25%. We need the 25%, which is the unrealized profit. 25% is the unrealized profit. The 10,350 is the cost plus the manufacturing profit. Because these are stocks at the end, the 25%, which is inclusive here in 10,350,000, has not been realized. These goods have not been sold. This value is overstated for the purposes of preparing the accounts. That's why when we began, we say that the provision for the unrealized profit on the closing stock of finished goods should be deducted or subtracted from the market value of goods in the balance sheet, market value of finished goods. So what is 25% here? We will have 25 divided by 125 times 10,350 times 10,350. So the balance here will be 2,070,000. So we need to get the difference between these two. Is this an increase or a decrease? So we get the difference, 1380. So you can see here there is an increase from 1,380,000 to 2,070,000. So there is an increase here, which will be transferred to the profit and loss account. This is an increase in provision for unrealized profit of 690. The total here 2070. So this is an increase in provision. So I'll come here and and include this increase. This is an increase in provision for unrealized profit of 690. So another expense here, learners, is the motor vehicle running cost. Motor vehicle running cost of 4,500,000. So we'll add all these expenses to get the total expenditure. 17 million plus 6 million plus 2 million plus 19,380 plus 4 million plus 690 plus 4,500. So 53,570. This is the total expenditure. Deduct total expenditure from the total income, minus 103,450. So my answer here is 49,880. This is what we call the net profit. So that is the net profit, 49,880. So we can now do the part B, statement of financial position. That is part B, statement of financial position. Statement of financial position. So first we write the name of the company, Limuru Manufacturers. Statement of financial position as at December 31, 202. We'll first have the non-current assets, which will have 3 columns: cost, accumulated depreciation, and net book value. The figures are in thousands. So the first non-current asset is the plant and equipment, plant and machinery. Plant and machinery. Then we have motor vehicles. Motor vehicles, 30 million, 16 million. 30 million, 16 million. The total here is 46 million. Now for the accumulated depreciation, candidates, you remember that the accumulated depreciation here, we take the accumulated depreciation at the start of the accounting period. At the start of the accounting period, what has accumulated up to the start of the accounting period, then we add the depreciation charge for the year, which appears in the trading profit and loss account. So for the plant and machinery, the accumulated depreciation from the balances is 12 million. We add the depreciation on plant and machinery, which in this case constituted part of the factory overheads. So part of the factory overheads, we had depreciation on plant and machinery of 3 million. So 12 million plus 3 million is equal to 15 million. All right. Then for the motor vehicles, the accumulated depreciation on motor vehicles up to the start of this accounting period on 1st of January. This information has to be provided in the question. We've been told that the accumulated depreciation at the start was 4 million. Then if you check the trading profit and loss account, the depreciation charge on the motor vehicles for the year was also 4 million, giving us a total of 8 million. So this is accumulated depreciation, 23 million. So we get the difference between the cost and the accumulated depreciation to give us the net book value. So the net book value on plant and equipment here is 15 million, and for the motor vehicle is 8 million, giving us a total here of 23. This is 23 million. That is the non-current assets. Then we add current assets. Current assets will constitute the cost of the stocks. These are stocks. In this question, you have stocks of raw materials. We have stocks of work in progress. We have stocks of finished goods. So the stock of raw materials at the end, 9 million. The cost of work in progress, 8 million. Then you have the cost of finished goods. Under additional information, we are informed that the cost of finished goods is 10,350,000. 10,350,000. Candidates, remember when we began this lesson, we said that the provision for unrealized profit at the end of the accounting period, provision for the unrealized profit on the finished goods at the end of the accounting period should be deducted, subtracted from finished goods. Provision for unrealized profit at the end, and we have just calculated it here. Provision for unrealized profit at the end of 2,070,000 should be deducted. 2070 should be deducted from the finished goods, because these finished goods, which are valued at 10,350, is inclusive of the unrealized profit. So that provision for unrealized profit at the end should be deducted from these finished goods to get the cost of finished goods, because the finished goods are always, goods or inventory is always valued at cost. Okay, must be valued at cost. So we will get the difference of 10. This is 10,350 minus 2070 is equal to 8,2,080,000. So that is the cost of materials and work in progress and finished goods. Then we check for any other current assets. We have debtors amounting to 28 million. Next we have cash at bank of 16,600,000. 16,600,000. Then remember the prepayment. 2 million. Prepayment 2 million. Then do we have any other current assets? No. So let's add the current assets starting from 9 million plus 8 million plus 8280 plus 28 million plus 16,600 plus 2 million. This is equal to 71,880. We add to the 23,600, total assets 95,480. Total assets. These total assets are financed by liabilities and capital. Liabilities and capital. Do you have liabilities? Do you have liabilities? Yes. Creditors. You have liabilities. One creditors of 5,500,000. Then we have accruals. Accrual, and additional information, we have accrual of 3 million, giving us a total here of 8,500,000. Then we have the capital. The capital, there is capital is 48 million. The net profit, you can have it this side. Net profit. Net profit. So then you have the two columns. I have the net profit from the trading profit and loss account of 49,880. From this question, you also have drawings amounting to 11,500,000 deduct. So we can now add liabilities and capital, starting from the current liabilities of 8,500,000 plus the capital, this capital 48 million. Then we add net profit 49,880. Then we deduct the drawings 11,500 is equal to 94,880. 94,880. So this is the total liabilities and capital. 94,880, which should be equal to 94,880 here. 94,880. This is 23. It's 23. Should be 23. It's 23 million plus 71,880. 880 is equal to 94. This is equal to 94,880. 94,880. Total liabilities plus and capital must be equal to total assets. So candidates, we've come to the end of our today's lesson, where we learned how to treat the unrealized profit in the accounts of a manufacturing entity. We saw that the unrealized profit affects both the income statement and the statement of financial position. We said that the difference between the two, that is the provision of the unrealized profit at the end of the accounting period on the finished goods, and the provision of the unrealized profit at the start of the accounting period, as demonstrated in this account. The provision between these two, the difference between these two at the start and at the end, at the start and at the end, the difference should be charged to the profit and loss account. And we say the difference may either appear on the debit side or on the credit side. If it appears on the credit side, then it's an increase in provision, which should be treated as an expense. If there is a decrease, which will appear on the debit side, then the corresponding double entry will be to credit the provision, the profit and loss account, and that will be like an income to the entity. That is how we treat the unrealized profit in the profit loss account. As for the balance sheet, I have just demonstrated here the balance sheet. We need to deduct the balance carried down on the unrealized profit at the end. This balance at the end is what we deduct from the finished goods, because the finished goods of 10,350,000 includes the profit that has not been realized. This is the market value, and we know, according to international standards, the inventories must be recorded at cost or net realizable value, whichever is lower. That's why we have to deduct this profit element that has not been realized from the market value of finished goods at the end to arrive at the cost, which must appear, which is supposed to appear or reflect in the balance sheet. So that is how we treat unrealized profit. Thank you, learners. Thank you for those who are asking questions. We will continue to answer all your questions. Below this video, there is a comment section where you can post your questions and your questions will be answered. For now, learners, I will send you to the financial accounting revision partner. We have very many questions here for you for your practice. Go to the topic on the financial statements of a manufacturing entity. There are enough questions for your practice. Here we have assembled 12 questions on manufacturing accounts. Go and practice. If you have any question, ask, attempt the question, mark your work, because answers are provided at the back of the book. Thank you and bye-bye.